Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. On this show, we sift through the entire market and put together a portfolio that suits your needs best. Now remember, every time you save a rupee, it's like earning a rupee. We're going to help you invest that money so it grows and works just as hard as you do every day in the office. On the show this week, we're focusing specially on women investors and young people. You can send in questions that you have to the email ID that's on your screen right now. Over the next half hour, we'll help a young woman create a corpus for her daughter's future. In our product review, we'll find out if it makes sense at all to stay invested in the Morgan Stanley Growth Fund. And we'll tell you how much you can earn if you skip buying that smartphone today. All right, let me bring in Kumar, the CEO of Value Research. Thank you so much for joining us on Investors Guide. Let's get straight to our first question. We have a question this week from a woman investor. Now, Sai Lavanya writes in from Navi Mumbai, Dhirendra. She tells us her husband earns a monthly income of 50,000 rupees. They've been married for 2 years and they have a little daughter who's a year and a half old. Now, they pay 9,000 rupees as rent and 26,000 rupees for other monthly expenses. Now, they don't have an emergency fund and they have no health cover or term cover. But Lavanya will receive 10 lakh rupees from her father in a couple of months and she wants to allocate this money. Now, she's already told us 1.5 lakh rupees she wants to set aside for a family function over the next 3 months. She wants 2 lakh rupees to be put aside for her daughter's preschool, which will be 2 years from now. And the remaining about 6.5 lakh rupees for her daughter's future, her higher education, that will likely to come up in the next 18 years. Now, she tells us currently her husband saves about 4,000 rupees every month and he's putting this money into a gold fund, into a pure equity fund, into an RD and a PF. Now, this is spread 1,000 rupees each. He can, starting now, put aside 5,000 rupees more every month and she wants you to help her allocate that money as well. Let's start first with the money she's getting from her father. Should she first and foremost think about that emergency fund and the health insurance before thinking of a family function?
I think absolutely. That's very important because all her investment plans will go haywire if she's faced with a medical situation or where the finest of investment plan will actually fail. So it is very important to have that cover before and have that emergency fund handy. Otherwise, that also has the potential to disrupt any investment plan. So these two things once in place, then she can get started. And I think plenty of time in hand, good lump sum amount available to begin with. She should approach investments very conservatively. So I would say look at our stable growth portfolio. The 6.5 lakh rupee which you are left with after your immediate expenses, which is the investable surplus of these 10 lakh rupees which is being made available. That should be spread over next 12 to 18 months in our stable growth portfolio. And once you are done with this, once you have through with this, then even the incremental money, the 5,000 rupee going into investment can also well be channelized there. All
right. So, Lavanya, first and foremost, unfortunately, we don't want you to set aside that money for a family function. Now, given your expenses and your rent, you need to put aside at least 1 lakh rupees in an emergency fund in a separate bank account purely for emergencies in case somebody loses their job or you need the money right away. Health insurance and a term cover for your husband who's your only earning member. You're going to have to set aside between 40,000 rupees almost to cover both of the premiums that you'll have to pay for both of those. And Dhirendra, they're giving you our stable growth portfolio for investments going further. But Dhirendra, for the money she wants to set aside for her daughter's preschool, which will be in 2 years' time, obviously you don't want that money going into even partial equity. Where would you like her to set that money into?
Because, given that this money is coming in the form of a gift, so she can consider a 2-year deposit.
Right, a 2-year deposit for your daughter's preschool money. But in the meantime, Dhirendra, there's money going into a PPF and a recurring deposit at 1,000 rupees each every month. Do you want them to continue making that investment as well?
No, as I suggested that, all the money, even the incremental money should find its way into the stable growth portfolio. One thing which comes to my mind that if her husband is in the tax bracket and he needs to make the tax saving investment, maybe a part of this, all this investment should get into a tax saving fund, which will get him the tax break.
All right. So our tax saving funds are on your screen right now. This is the recommendations for tax saving funds for this year. And remember, if you use a stable growth portfolio instead of using a recurring deposit, after a year, all of those returns are also tax free. You can write back to us if you have any more questions about your money. Let's take another question. Kalyan has written in there that he wants to know where he can invest 10,000 rupees every month or 1 lakh rupees every year to get an interest of 10 to 15%, and he wants a guaranteed interest and no risk on his capital. 15% seems like a really long shot, Dhirendra. Does a recurring deposit make most sense for him?
Yes, recurring deposit makes sense, but one should be conscious of this. When you are seeking guaranteed return, then you will get low return. That apart, it will all be taxable. One is that equities do give you superior return over a longer period. This is your long-term investment, but you're extremely uncomfortable. So I would say that you have a very clear choice. You will get post-tax return of 7-8%, which will be guaranteed, or else you will have to take chances, and the potential return might be higher, but you will have to, reconcile with the ups and downs of the market. And if this is a long-term investment, I'm sure that you are unlikely to be disappointed.
Well, Dhirendra, for other investors like Kalyan, now Kalyan has not told us what his investment horizon is, so what he needs the money for, how long it's going to be invested, he hasn't told us. But for the viewers who are watching right now, how do they pick between putting their money into a recurring deposit or into a debt fund, which is similar, but of course the risks are very different? How do we choose which one suits us better?
Both have their, their own advantages and disadvantages. When you do a recurring deposit, you get guaranteed return. It has wide accessibility. Any neighborhood bank will provide you a recurring deposit, though accessing mutual fund may not be that easy. That apart, many mutual fund advisors will not be very, you will not get great service in terms of choosing a fund and doing a SIP in a debt fund like a recurring deposit. And that apart, not getting a guaranteed return.
All right, I hope you wrote that down. Now we're going to take a very quick break. When we come back, Dhirendra is going to stay with us. And in our fund review this week, we talk about the Morgan Stanley Growth Fund. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review. And this week, we're looking at the Morgan Stanley Growth Fund. Avan is here to give us an introduction. Avan.
Thanks for that, Faye. Now, as we already know, the announcement was made in December last year. HDFC Mutual Fund AMC is acquiring Morgan Stanley's mutual fund assets in India. And our fund in focus this week is one of the assets that will soon be an HDFC fund. The Morgan Stanley Growth Fund was launched as a close-ended fund in February 1994, but turned into an open-ended fund in Jan 2009 after 15 years in operation. During this period, the fund gave investors an annualized return of 10%, well below its peers, the Franklin India Blue Chip and the Franklin India Prima Fund, which returned 23.81 and 16.91% respectively. Even after that period, the fund has failed to impress, failing to recover from the crash of 2008 when it fell 50%. Over the years, the fund has floundered in the middle of its category, never rising to the top of the leaderboard. To sum it up, if you invested 1,000 rupees in this fund when it launched, you would have 6,897 rupees today. Keeping in mind the fund's underachievement, is it time for you to pull your money out? Or will the fund managers of HDFC be able to save this fund? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you so much for that update. Well, Dhirendra, the Morgan Stanley Growth Fund has not been a performer. And to add to that, Morgan Stanley has now sold all of those Indian assets to HDFC. So there'll be a transition that will also take place. Does it make sense at all for us to hang on to this fund and to stay invested and wait for that transition?
Yes, on a risk-adjusted scale, it has improved a little bit, but that doesn't make much of a difference because this is a very mainstream category. And quite a few, significant change. One is that, when we look at the 20-year performance of this fund, it is extremely disappointing. Also compare it with, another fund which was launched exactly at the same time. Then this fund was Zurich India Capital Builder, launched in the same month, same year. And when we look at the NAV, it is twice as much. 65 rupee and 125 rupee makes hell of a difference. That apart, Morgan Stanley Growth Fund had an unusual advantage. It started as a closed-end fund and remained one for first 15 years. Only 5 years back, it got converted into an open-end fund at the expiry of its closed-end term. So it was at absolute liberty to take a call build a portfolio the way it wanted to. It was not faced with, daily redemptions and inflows into the fund, which normally is, many a times, it is a constraint for a fund manager to operate.
Well, if you're investors of inertia, like Dhirendra says, and you put your money in the Morgan Stanley Growth Fund and you haven't removed your money for this long, it's time to move your money now. Dhirendra, could you give us alternative investments if you're going to pull our money out of this fund right now?
Go for our selection of multi-caps, which is Quantum Long-Term Equity Fund, or ICICI Prudential Dynamic, or Templeton India Equity Income Fund.
3 funds on your screen right now as alternatives to this fund, the Morgan Stanley Growth Fund. Remember, Dhirendra said it's time to pull your money out. Even if it's moving to the HDFC basket, don't wait for that move. Pull your money out right now. Dhirendra, finally, give us your rating of this fund. You gave it 2 stars last time. Where would you place it this time?
I'll place it there itself. It has been a below average performer, not a disaster, but not a fund worth, remaining invested.
All right, not a fund worth staying invested in. That's the Morgan Stanley Growth Fund on Investor's Guide. Let's move on to our hold or sell segment. Well, H.S. Karkera has written in, Dhirendra, he's a 65-year-old retired banking officer. He puts aside 60,000 rupees in 12 mutual funds every month. Now, he tells us this is money that comes out of his fixed deposits and interest from his other investments. He wants to bring down that investment to 30,000 rupees a month for the next 10 years with the hope of creating a corpus of 1 crore rupees. He sent us a list of the funds on his investment chart, and I want to take them together because 12 funds is a long list. Right on top, Franklin India Blue Chip and ICICI Prudential Focus Blue Chip. Would you like him to continue investing in both of these funds?
Both these funds are good large cap equity fund, and so depending on his time frame, and these 2 funds, if I have to choose 2 large cap fund, it will be these. So maybe it's worth being there.
And he's also investing in the ICICI Prudential Dynamic and the Franklin India Prima Plus Fund. Dhirendra, continue these investments as well?
Yeah, these 2 funds, again, they are, he has chosen his funds carefully and relatively superior funds with superior performance. So these are, again, 2 large and mid cap funds which are doing very well and worth holding.
I'm going to take the next 3 funds together. He has L&T Equity, Reliance Equity Opportunities and the IDFC Premier Equity Plan. He has a slightly larger amount going into IDFC Premier Equity. Dhirendra, continue with this investment as well?
Yes, I would say that Prima Plus could well be a mainstream fund, and likewise, the IDFC Premier Equity is a very impressive fund, has been particularly impressive through the lean times. So, in fact, it has done well than most others.
He also has the Canara Robeco Tax Saver Fund, Dhirendra. This has popped up several times when we've talked about tax savers. It's a fairly impressive fund. Should he continue that investment? Assuming, of course, it's an SIP, he won't be allowed to pull that money out for the next 3 years?
Yes, this has been our recommendation for a while, and this fund continues to do well. And so if this is his ATC allocation, 60,000 rupees a year by way of 5,000 rupees per month, he can carry on.
He also has a mid and small cap fund. This is the DSP BlackRock Small Cap Fund, 5,000 rupees every month. Continue this investment as well, along with the SBI Magnum Emerging Business, and this has been quite a performer. Both of these funds in his portfolio, would you like him to continue both of them?
If he has the